Making a profitable, simple, proven strategy is one of the most difficult things to do as a trader, in my opinion. Traders often have a difficult time making a proven, stupid, simple strategy and sticking to it long term. In this video, I want to share with you one ICT trading strategy for life that is proven, stupid simple, and extremely profitable. This exact strategy has allowed hundreds of my students to become consistently profitable. With that being said, let's dive into it. Okay, so I've broke the system down into 4 simple steps. Step 1 is the most important, yet it is often the most overlooked. And what I often see, so let's say you have a market right here. And what happens? We break this high, and then traders are maybe interested in getting short right here. So they might get short with a stop loss above this high right here. And then what happens? You get stopped out, and then you think about, okay, I'm going to get short again. So you take another short position, stop loss above the high. Maybe this plays out. Maybe you take profit at a 1 to 2 risk to reward. But then what's happened is we've took out another level, another point of interest below here. What do? Well, we've took out a key level. You're then going to look for a buy position. So you're going to buy this market, but this time get stopped out again. So you buy here, stop loss below here, you get stopped out. What do? You buy again. Maybe this plays out. But the problem right here is that you're flip-flopping. The problem is that you don't know what your bias is for the day or for the session. And that's why step number 1 is the most important. And step number 1 is directional bias. So you should know every single day when you're turning up to the markets. Am I long bias, right? Am I only looking for long positions? Am I short bias? Or do I have no bias in this market? And then it's down to you as a trader to make sure that you stick with what you said you were going to do, with what your bias is for the day. So how can we identify directional bias in a stupid, simple way? And this right here is where you're going to have to hear me out. So the problem that I see so often with traders is they're using subjective ways to identify directional bias. So this could be a 4-hour order block. This could be a daily fair value gap, a daily order block. Maybe it's a weekly draw on liquidity. But the problem is that these are very subjective. Like, how do you define which point of interest, which level are you actually looking for your directional bias? And so what I recommend to do, and this goes against the grain, this is going against pretty much probably everything that you've been taught. And I recommend using a simple 50, 100, and 200 exponential moving average. So when you're trading on an intraday basis, right, you're trading on the 15-minute time frame, this is how you can work out your bias for the day. So example, when the 50 is greater than the 100, which is greater than the 200, this indicates to you as a trader that you're only going to be looking for long positions in this market. You're not going to be selling. You don't have a no bias market, right? Only long positions. And it's your job as a trader to be accountable to that. So what I recommend to do, so 15-minute time frame, you can apply your EMAs right here. So indicators tab at the top of your screen. It's this indicator right here, EMA 20, 50, 100, and 200. This is by Dr. Sweets. So you can click this, add it to your chart, add it to your favorites, and this is 3-in-1. Well, technically 4-in-1, but you don't need the 20. So this one right here, this top one is the 20 EMA, exponential moving average. You don't need that one. You just need the 50, 100, and 200. Then you can click OK. All right, so example of a sell directional bias, meaning you would only be looking for shorting opportunities, right? So again, 15-minute time frame. This is the opposite, right? Vice versa. So 50 EMA, less than the 100, less than the 200, sell bias market, meaning only going to be looking for shorting opportunities. And as you can see, right, any opportunity in here, right, and we're going to get onto entry models and how to time the market correctly in a moment, right? But any opportunity in here is a opportunity to get short. And as you can see, these trends continue and continue and continue. So I see a lot of people using market structure, but again, very subjective, right? How do you define market structure? Are you on the 15-minute time frame? Are you on the 4-hour time frame? How are you defining an actual swing high or swing low in the market, right? I can show you at least 15 to 20 ways right now to identify market structure for your bias. Whereas this way right here is literally stupid simple. It takes all of the guesswork out of it, and literally 2 minutes, you know your bias for the day. You know what you're looking for. Then as soon as we get any of the EMAs crossing over, so right here, right, 50 crosses over the 100. So this happened right here. As soon as that happens, no bias market. The EMAs are not in order. You have no trending conditions, meaning that price is more likely to consolidate. And so if it's likely to consolidate, you don't want to be positioned in the market. You don't want to be looking or executing in this market. And so that is the 3 extremely simple ways to identify your directional bias. Either you're bullish, you're bearish, or you have no bias in the market. Okay, so step number 1 was great, but step number 2 will allow you to time the market correctly. So what I often see happening, right? Let's say you've identified a long bias market, right? So you know that price is more likely to go higher, right? More likely to go to the upside. And so what I see people doing all of the time is they FOMO in at the high, right? And maybe you've got a stop loss below this swing structure right here. And then what happens is price comes down, stops you out, you get liquidated, you get stopped out. And then what happens is price then continues in the intended direction, in the direction that you thought that price was going to go in the first place. And the reason why this is happening is because you don't understand session-based liquidity. And so this is step number 2. So as you can see right now, there's 3 different colored boxes on my screen. We have the Asia session in red, we have the London kill zone in blue, and we have the New York kill zone in green. So we have the Asia session. This is from 6 p.m. until 11 p.m. Eastern. We have London from 3 till 5 a.m. Eastern, and we have New York from 8 until 10:30 a.m. Eastern. So we use these shaded areas to know when are we going to be trading in the market, and 2, we can use it to identify session-based liquidity. Okay, so imagine that you are a large entity or a large institution. In order for a large institution to buy at market, they need hundreds and millions of traders on the other side of that trade. And so liquidity in trading is how easily an asset can be bought or sold quickly without drastically affecting its price. So for example, imagine that you are a large institution, a large entity in the market, and let's say you want to buy the market right here. Well, the problem is that there's not enough people on the other side of this trade. There's not enough people on the wrong side of this market for institutions and bigger players to buy here. What would end up happening is they would buy, the market would start rocketing to the upside, right? Let's say they want to buy $500 million of a position right here. Let's say they want to position this in. Well, they might only be able to buy, say, $200 million right here. Price starts pushing aggressively. Maybe they can fill another 100 million here and then another 100 million here, right? And what's happening here is they would be encountering slippage in the market. So we need to know, where can institutions be filled in this market effectively without affecting market price and without actually giving them any slippage in the market? Well, areas that they can do this are previous sessions highs and lows. So for example, based on step number 1, based on what I taught you before, right? Well, 50 EMA, greater than 100, greater than 200. This indicates to you as a trader, long bias market. And therefore you need to ask yourself, where are the levels in the chart that institutions can use to position into the market? And then it's our job as a trader to trade in line with that. So for example, when you're buy bias, you need to identify sell side liquidity. Well, we have that below previous sessions lows. So we have the London low, we have sell side liquidity below here. What do we also have? Well, we have the Asia low, right? So this is the Asia low. We also have sell side liquidity below here that institutions can use in order to position and to get involved into the market. The reason why this works is because of something called inducement, right? So when price comes down here to the London session low, retail traders are going to see this as a double bottom in the market. So they're going to be looking at buying, right? Stop loss below the London low. And therefore, when we take the London low out, these traders that are getting long, seeing this as a double bottom, right? They're going to be stopped out. Therefore, they are going to be providing sell side liquidity that institutions can use to position into the market. Vice versa, right? When we break and we get below the London low, traders are going to be shorting this market, right? They're going to see this as a breakout to the downside. They're going to be getting short, stop loss around here, providing sell side liquidity. Why are they doing that? Well, because they're shorting. Therefore, we know that a lot of traders are going to be induced into this market around this level right here. And all inducement is just trading activity that makes or forces you to do something that you wouldn't normally do. So it sort of induces you, it entices you into the market to position. And most of the time, retail are going to be on the wrong side of the market. And therefore, it's this inducement right here below this level that is providing the liquidity for bigger players to position, to get involved in the market. Therefore, their buy orders can be matched up. The institutional buy orders can be matched up with all of these retail sell orders. So this allows them to get filled without slippage, without affecting current market price. So if you're long buyers in the market, you need to see sell side liquidity taken out. When you're long buyers, you don't really care about buy side liquidity. So what you're looking for is, can price come down below a previous session's low, take out sell side liquidity, induce traders into this market. You know people are going to be on the wrong side of the market, therefore you can use that to your advantage to actually build an edge in the market. So we're waiting patiently. We're waiting for price to come down to liquidate below here. And this leads me on to step number 3. So what I see all of the time where I see traders going wrong, right, from my 8 years of trading experience, is they're looking at really complex trading models. So, let's say that you have a run of sell side liquidity, right? You take out this level, people are induced here. But then what I see people doing, right? What I see people doing is they're looking, right? They're dropping down to the 1 minute time frame. They're getting emotional. They're way too zoomed in. And so what they're going to be doing on the 1 minute time frame, right? You have a low, you have a lower high, followed by a lower low. So what traders are going to be doing is they're going to be looking for a pullback in price, a change of character, right? Then they're going to be looking for another pullback, and then you can look at getting long in the market. So this is basically going from bearish order flow to bullish order flow. But the problem is this takes so much energy, so much chart time. And again, it goes down that rabbit hole of how do you define market structure? Do you use a 2 candle rule? Do you use a 3 candle rule? These are very subjective things in the market, which is why traders are struggling so much, right? Do you take a fair value gap right here? Do you take an inversion? Again, these are all very subjective things, which often leave you feeling confused, feeling overwhelmed. So what if I told you there was a very simple entry model that is repeatable, reliable, reduces your chart time, and is literally stupid simple? Let me break it down. So once you've seen a run of sell side liquidity, you're preparing yourself to get long in this market, but you need to wait for a kill zone, right? So you need to wait for either you're executing in London between 3 and 5 a.m. Eastern, or you're executing in New York between 8 and 10:30 a.m. Eastern. You're not going to be taking any trades outside of these windows. So not only do we use kill zones for liquidity, identifying buy side and sell side liquidity, we also use them for executions, knowing when you should be entering into the market, and this will drastically improve your win rate. So all that you're waiting for, step number 3, is a bullish 15-minute confirmation. That's it. During a kill zone, right? So it has to occur during a kill zone between 8:15 a.m. up until 10:30 a.m. Eastern. I will not be taking any entries outside of this kill zone. Okay, so that is exactly what we get right here. We see the liquidation, we see a 15-minute bullish confirm. But you don't enter on the closure. This is really important, right? You enter on the break of this high, right? So you're entering either via a buy stop in the market as momentum is pushing into the market, or you're entering via a market execution. You're manually entering on the break of this high as the next candle opens and momentum pushes and it tags you in. So remember, not on the closure, on the break of the high. This will increase your win rate, and this will make you more profitable over the long term. Then this leaves me on to step number 4, which is invalidations in targets. So where I see people going wrong, which is hilarious, I see this all of the time, and from my experience, is people are targeting crazy risk to rewards. People, you're entering here, traders, they're looking for home runs. They're looking to take out, you're entering on the 15-minute time frame, but you're looking at like a weekly or monthly level of liquidity. You're targeting a 1 to 10 risk to reward. When you're starting out in the markets, I recommend that you target a fixed, mechanical, repeatable 1 to 2 risk to reward. This will take the guesswork out of your trading. This will prevent you from overanalyzing, overthinking, and this will take the guesswork out of your trading. In terms of placing a stop loss, it needs to be uniform. It needs to be the same every single trade. Otherwise, your system system is not repeatable and you don't have an edge. It's pretty much useless at that point. So what I recommend is your stop loss goes below the liquidity sweep, below the low, right? Sometimes it's the candle low. Sometimes it's the liquidity sweep low, which, might be down here, but that's okay. Wherever the low of your liquidity sweep is, your stop loss goes below there. You account for spread, account for slippage, and then you look targeting a mechanical 1 to 2. And then you've got to be patient. So I was actually tagged in this trade right here. And so for anybody thinking that I'm cherry picking this trade, which to be honest is a fair assumption, here was the analysis that was sent ahead of time to my exclusive community. And I actually took this on a live stream with all of my members. And then it was just a case of setting and forgetting. So once you're tagged in a trade, there's no micromanaging, right? Accept your risk. Understand, okay, if this trade does hit my stop loss, this is how much I'm going to lose, right? But do not interfere. Set and forget your trade. Accept the outcome, right? Accept that you don't know the outcome because we're trading probabilities. We're trading an edge in the market. So I often see traders micromanaging, closing early, getting emotional, right? You can see we've had a drawdown right here of around 50% towards my stop loss. So this is where a lot of traders may have went wrong. They may have closed this early. They may have micromanaged. And as you can see, within 45 minutes, this trade had hit take profit for a 1 to 2 risk to reward. So I took this on a live stream with hundreds and hundreds of members. And this is where traders would go wrong, right? So, your plan is to take that repeatable fixed 1 to 2. And then what they're going to do is they're going to see this, this crazy gladiator candle right here. And they're going to ask themselves, oh, what if I held this? I could have had a 1 to 5 or a 1 to 6, right? And then you go down the rabbit hole of changing your system, amending your strategy. But that's not your job. Your job is to not go for home run. Your job is just to take that small, repeatable piece out of the market over and over and over again. Bank your profits, take your profits, come back the following day, the following session, and rinse and repeat. So it's very easy to get caught up in that sort of one trade mentality. Sample size of trade, N equals 1, right? And you get caught up in that, and then you're down the rabbit hole. So I encourage you not to think on a trade by trade basis, but I encourage you to think on a zoomed out basis, on a long-term time horizon, right? So it's not about, what was the result of one trade or 1 week or 1 month. What is more important is what was my results in Q1? What was my results in Q2, etc. And, even more zoomed out, what was my results over the year? Right? A lot of traders, they don't have that zoomed out long-term time horizon. They're stuck, down the rabbit hole of one single trade, letting that define you as a trader. So understand that you're trading an edge, right? And this setup right here, just to be fully transparent with everybody, right? This setup is an A+ trade. This setup has around a 50% win rate, meaning that, you take 10 trades, you're going to lose 5 of them right here with this system. And I know that based on years and years and years of backtesting this system and trading this live. But the good news for you, right, is that if you have a 50% win rate with a 1 to 2 risk to reward, right, you only need anything more than a 33% win rate. You make money long term, right? Not short term, right? You could have 3, 4, 5, 6 losses in a row, possible. But again, you're trading an edge, you're trading a probability, you're trading outcomes. And so professional and profitable traders, they are zooming out. They don't care about the results for a day or a week or a month. And so this is my stupid simple 4-step trading strategy that is proven. If you haven't already, I do free live streams every single week. So I encourage you to join the free Discord community to access the free live streams. So this is the 4-step strategy. Number 1, directional buyers. Number 2, liquidity sweep. Number 3, confirmation. Number 4, stop loss and take profit placement.